Howdy everybody and welcome to another stock analysis video. Today we are going to be analyzing the company Micron. If you guys have been around my channel, well, you guys have pretty much noticed that I absolutely adore my semiconductors and chip makers. So, seeing that Micron actually has earnings coming out tomorrow, as I'm recording this, it is the 28th, they have it on the 29th, let's see, analyzing this company and trying to pinpoint where a good target price might be to buy them at. So with that said, let's get started with this analysis. Starting off, guys, we're going to come here to the dividend summary. This company does pay a dividend, however, fairly surprising, and you guys are going to see why, and not in a good way. Dividend yield of 0.51%, which ends up being 10 cents a share for an annual payout of 20 cents. Sounds good? Okay, awesome. So you're thinking 20 cents, 10 cents, okay, so semi-annually, right? However, if you guys can see right here in the dividend frequency, they pay quarterly, which makes absolutely no sense, because if they pay quarterly and their amount is 10 cents, then this should be paying out 40 cents, not 20. So what's happening here? Well, we can actually see this right here in the 5-year growth rate and of course the dividend growth. But just looking at the payout ratio for just 1 second, the payout ratio is very, very small. And also this has to do with the fact of how they pay this dividend. So if we actually come over here to the dividend history, we can actually see that their dividends pretty much overall have been, well, non-existent. So the last time they paid it was in December 30th, 2021 and September 29th, 2021. And beyond that, there has been absolutely nothing when it comes to the dividends. In fact, the last time they paid a dividend was on May 6, 1996, which was around 3 cents. So this has been, yeah, this company, when it comes to dividends, it is not that good. And, well, just based off of that, I do not consider this a dividend paying company, even though that they do have one for some reason, right? Ex-dividend date, if you care about it, was December 31st. Payout date was January 18th. And, of course, they pay their dividends quarterly, which, let's face it, not really. But there's more to just a company than just a dividend. So let's analyze this company's fundamentals. Ticker symbol MU, market cap of $89.4 billion, PE, guys, of 12.35. So just based off of their earnings, it's telling me that at the current price of $79.86, this might be a pretty decent buy. Now, we're going to take a look at other metrics and see if they can tell us a little bit more story as to how this company actually works. Now, guys, I understand that they do pay a dividend. However, seeing that their dividends has been all over the place, I'm going to consider this a 0% yield when it comes to dividend, because I just cannot foresee this company actually consistently paying a dividend into the future, seeing that since 1996, they have not paid a single penny up until 2021. So I'm going to take the annual dividends per share in this calculator at $0. And now, taking this into account, this tells us that the 5-year average free cash flow is going straight into themselves, reinvesting, paying down debt, buying back shares, etc. Now let's come over here to the fundamentals, guys, starting with a net income 5 years ago of $5.1 billion to 1 year ago of $5.9 billion, increase of 15%. And if you guys just see this right here, when it comes to the net income, this is fairly bad, right? I mean, 5 years ago, 5.1 to 1 year ago of 5.9. Essentially, they have gone absolutely nowhere in 5 years. And not just that, take a look at the 4 years ago. They just skyrocketed and then went down and down again, and then they slightly went up just last year. This is not consistent. This is not something that you want to see with their net incomes. This is a really, really bad metric. Yes, it is increasing on the 5-year scale, but if you zoom out and take a look at the bigger picture, this is not a positive metric in the slightest. Now let's take a look at the free cash flow, guys, the lifeblood of the company. Cash from operations less your capital expenditures. Very similar to the net income. Actually, this is a lot worse than the net income, honestly. 5 years ago of $3.4 billion to 1 year ago of $2.4 billion. Guys, that is a decrease of 29% with a 5-year average free cash flow of $3.6 billion. Now, we see the exact same thing that we see with the net income here. 4 years ago, they shot up dramatically, and then 3 years ago, they brought it back down, and 2 years ago, they were barely positive on their cash flow at only $83 million. That's really, really bad, guys. Now, they did bring it back up last year. However, again, this is not consistent. This is not what you want to buy. Remember, when you buy a company, you buy their cash flow, you buy their incomes, you buy their revenues, you buy their debts, you buy their shares outstanding, you buy all of this stuff. And seeing a company like this is telling me that their future free cash flow is going to be rather the same, and it's not really worth paying for it. Now let's take a look at the revenue 5 years ago of $20.3 billion to 1 year ago of $27.7 billion. This is an increase, guys, of 36.33%. And, well, this is a little bit better, I guess you could say, than the two metrics above. However, we see another similar trend. 4 years ago, they shot up to around $30.4 billion, and then it went down 3 years ago, and then it went down again 2 years ago, and then it shot back up 1 year ago. I don't necessarily know what's happening here, guys. This is a consistency when it comes to the past three metrics. If one of you guys know, please comment it below, because I honestly do not know. But just looking at this from a 10,000 foot view, this is really inconsistent when it comes to these metrics. These are the metrics that you do not want it to be like this, right? You want it to be nice, consistent growth, or nice, consistent, I guess, decrease, right? Because if you know if it's a nice, consistent decrease, at least you know what you're getting. Here, it's all over the place, and it's really difficult to come up with a future assessment, seeing that they have not been able to be consistent within the past 5 years. Now let's take a look at the total assets minus the total liabilities. Guys, this one simulates if the company were to liquidate all of their assets, would they be able to cover their liabilities for starters, and two, how much money would they have left? And wow, this is actually really surprising. I was not expecting this, seeing the past three metrics, and honestly, I wish the past three metrics looked like this. Currently, guys, they had $13.7 billion after liquidating all of their assets and paying off all their liabilities. That's really good, right? And not just that, within the past 5 years, they have been increasing it consistently up until today, which is again really good. The fact that in the past 5 years, they have been above water every single time. Average assets, guys, is around $17.2 billion. Average liabilities around $6.2 billion. Average assets minus the average liabilities is around $11 billion. Now let's take a look at the silent killer when it comes to investing, the shares outstanding. A metric, guys, that people just tend not to understand. And this is basically how many shares there are out there in the market for you to buy, for investors to buy. The more shares that there are outstanding, meaning the more shares the company issues, the less of an ownership you have as the investor. That's why you want this number to be going down. You want the company to be buying back shares. You don't want to be diluted. And, well, here when it comes to Micron, 5 years ago of 1.1 billion shares to 1.12 billion shares, which is a slight increase in the 5 years of around 0.72%. And from the previous year to the current year, so from 1 year ago to today, they had issued around 0.09%. This isn't a big deal for me, guys, right? A 0.72% on the 5 year and a less than 0.1% on the previous to the current year. This isn't that bad. At least when it comes to this metric, I would just ignore it. However, it adds up, right? We just saw three metrics: the net income, the cash flow, and the revenue pretty inconsistently, and the fact that they are issuing shares. Even though it's not that much, they're still issuing shares. This is really underwhelming. And lastly, we got the cash equivalents, and currently, guys, they have around $8.7 billion in cash equivalents with an average cash equivalents of $7.1 billion. Now we need to make some assumptions: low, median, high, and we're going to use three different factors to come up with a target share price and a target share price after debt, and afterwards we're going to add a margin of safety to it. Now, with the three different factors, I'm going to be using the revenue growth, which I'm going to be getting from Seeking Alpha's growth tab. They have the revenue growth year over year and the revenue growth forward, seeing those and come up with an estimate between those two numbers. Projected share buyback, I'm going to be using the graph that we just saw with the shares outstanding, make an assessment with that, and with the required rate of return, I'm going to put it at 10% to match the S&P 500 at its best years. So for my low assumption, I'm going to assume a growth of 20%, projected share buyback of negative 0.5%. This means that they're going to issue shares at 0.5%. This comes out to be, guys, a target share price of $71.69. For my median assumption, I'm going to say a growth of 23%, projected share buyback of 0, meaning that they're not going to issue or buy back shares. This comes out to be $78.98. And lastly, for my highest assumption, I'm going to assume a growth of 26%, predicted share buyback of 0.5%, meaning that they're going to buy back shares at 0.5%. And this comes out to be $86.85. Now we need to adjust for debt. The way we do this is we take their cash and equivalents and we add the net debt. If they have more debt than cash, this number comes down. If they have more cash than debt, then this number comes up. In doing so, as you can see, this number goes up slightly to $79.40 for my lowest assumption. $86.73 for my median assumption, and $94.64 for my highest assumption. Now, me personally, I like to add a margin of safety, just so that way we do not overcompensate and overpay for something. Therefore, for my lowest assumption, I would like to buy between $67.50 to $75.43 with a margin of safety of 5, 10, and 50%. For my median assumption, we would like to buy between $73.72 to $82.39. And for my highest assumption, I would like to buy between $80.44 to around $90. Guys, the current share price is $79.86. Now, if you believe my assumptions, then this is a pretty good buy, even at my lowest assumption, taking into account the debt, which is actually really, really good. Because if you take into account the debt and the current share price actually falls fairly close to that target share price, adjusting for debt, pretty much is telling you that this is pretty good value, right? Now, when it comes to the margins of safety, it even comes close to that with the 5%, 10% with the median assumption, and it pretty much is all solid with the highest assumption. So if you believe my assumptions right here, then this is an all-out buy at the low, median, and high assumption, depending on which number you actually believe. Now guys, these are my assumptions. As I always say in every single video, this is not financial advice. I'm just giving you guys the raw data that everybody has access to, and I'm just giving you what I would put this company at. I'm not telling you guys what to buy. You guys do whatever you want with your money. I don't control you guys, but I'm just giving you guys my opinion. If you do not agree with my opinion, then by all means, that's fine. I 100% like that actually, because I have this calculator available for free. Anybody can have it. Just go to my discounted free cash flow calculator videos in my channel. There's a playlist for it, and you should get this calculator. I have it available. Anybody can have it. You just come over here, make a copy, and you can make your own assumptions for it, right? Because at the end of the day, every investment is a present value of all future cash flow. My assessment is going to be different than yours. Warren Buffett's assessment on companies is different than his right-hand man, Charlie Munger. It's just the way it is, right? Everybody's different. So all I'm asking for in return, guys, is like, subscribe, comment. It really does help with the algorithm on YouTube. I would love to get to 500 subs as soon as possible so that way I can get my community tab. I'm giving you guys something for free. All I'm asking is for 2 seconds out of your time to hit that like, hit that sub, and if you can, if you want, leave me a comment. All in all, guys, when it comes to Micron, honestly, for a company this big, I was not expecting this. This is actually it's really underwhelming, right? I mean, their fundamentals, their net income, cash flow, revenue is all over the place. It's actually really difficult to come up with a future perspective on the cash flow and the revenue. Now, the fact that they are pretty solid when it comes to their debts, that's a really good thing. The fact that they have a lot of cash, that's also a really good thing. And the fact that, well, yes, they have issued shares, however, it's not a lot. It's not that bad, right? But the main three things when it comes to their profits, that to me is huge. And seeing the fact that their dividends are also all over the place, this is a pretty much a no-go for me. At least this is my opinion. But that pretty much does it for this video. As I said, if you like, comment, subscribe. You can follow me on my new tech sites of BitChute, Odyssey, and Rumble. Links in the description below, where in addition to my stock analysis videos and crypto videos, you will find exclusives as well. And in regards to YouTube, Odyssey, and Rumble, I have a Let's Play channel currently playing through Sonic Unleashed, so if you want to catch that, you can follow me there. With that said, peace out, and be on the lookout for the next stock analysis video.